Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. The 12th of March, Wednesday, 11 a.m. on the East Coast, 8 a.m. on the West Coast, and whatever time it is in between. Dan, Nathan, Guy Adami. By the way, Dan, if it's Wednesday, bitch, yes, it is Butters. You got to be quick in this man's game, Dan. How are you today?
That would be John Butters, the senior earnings analyst over there at FactSet, Guy.
Right.
And we're going to hit his note in just a little bit here. You know, this is a sad one for us on a Wednesday, but it's actually a glorious day for someone else. Usually Liz Thomas of SoFi is with us. This is going to be her first Wednesday off in a while. She's due to have a baby, and we can't wait to hear whether she calls it Daniel or Guy. But we'll keep you guys
on both.
We'll keep you guys posted. Guy, you and I did the risk reversal pod this morning. We're going all over the CPI. I don't think we have to spend a lot of time on that. I think what's more interesting today is the price action in the market. We got to bounce, in the equity market. You and I and a lot of other market participants thought we were due for a bounce. The S&P yesterday at its lows was down about 10%. The NASDAQ was down about 13%. But the bounce that we got after CPI, pretty short-lived.
It's interesting to me. And again, there's a lot of day left. It's 11 a.m. on the East Coast, so we still have quite a lot of time for this market to rally. But the fact that CPI came in, I'm sure much to the relief, I guess, of bulls and pundits and what have you, the fact that it came in cooler. The initial reaction was, I think at one point in the pre-market, the S&P was indicated up 80 or so handles, and that we have now sold off approximately 80 or so handles is fascinating. I don't know what it's on the back of. I think that this weakness in the market, as I've said a number of times, where we've changed paradigms where people are selling rallies now, and that is clearly evident today. You still have a VIX. It's either side of 26 or so. And we're going to talk about this, but one would have thought with that weak CPI print or softer than expected, you'd see a meaningful rally in the TLT, yields going lower, and we're not seeing it, Dan. Now, we're seeing it basically unchanged on the day, but you're not seeing it bounce the way that I thought it would. So a lot of strange things taking place in the first, hour and a half, 2 hours of the day.
No doubt. I mean, listen, after the sort of decline that we've had in such a short period of time, you would think that it wouldn't take too much, slightly positive news just to kind of give investors a slightly different mode. But it also says something about risk taking right here. After 2 consecutive years of 25% returns in the S&P 500, and it seemed to be sort of smooth sailing. I think investors, got comfortable with the fact that economy was okay, trading, at least the GDP was above trend, the pre-pandemic trend, that we were kind of working off some of the excesses as it related to, the fiscal stimulus and the like. We saw, the unemployment rate kind of just stuck, in and around 4% or so. And, the fact that the Fed was, had the ability in the fall to get more accommodative. I think you would not use that term accommodative as it relates to the sort of cuts that they had and for the reasons that they were doing it. But man, the back and forth, there was an article, on the tariff stuff, right? And so once you start threatening the tariffs, once you push them out, exclude different things, then threaten higher tariffs, he was going to go from that, he being Trump, from 25% tariffs on lots of stuff for Mexico and Canada to 50%. That was I think aluminum and steel. When you keep going, that's not a great negotiating tactic, in my opinion. You know what I mean? Because ultimately now we have all these threats of retaliatory tariffs and, the EU in particular, and they're targeting certain parts of the U.S. where the manufacturing is and certain, that sort of thing. I just feel like this is the thing that is weighing on, sentiment as it relates to markets.
Yeah, this is not helping, obviously. And, whether the tactics are sound or not, I'm not going to opine on that. But what I will say is, people always talk about the market hating uncertainty. Well, first of all, when I hear people say that, it makes me wince because there is never certainty in the markets, in my opinion. But it's the level of uncertainty I think that people should speak to. And I think the level of uncertainty is we haven't seen in quite some time. And it's predicated on exactly what you said. And that's why, by the way, I think you have a VIX at 26 or so. But I think the one thing that is concerning market participants, whether it's the machines, individuals, hedge funds, institutions, whatever it is, was that interview on Sunday when there was a talk of, again, the Chinese play a 100-year game and we typically play a quarter-to-quarter game. That was President Trump talking to Maria Bartiromo. And, his, I guess, I want to say admission that there's going to be some soft patches as we try to get to the other side of this thing. And I think when he talks about that, he's talking specifically about the market, and whether or not he is, it's hard for us to understand, but I think the market isn't interpreting that way. And I think that's why we've seen this sort of second round of sell-offs.
Yeah. And the sell-off today is really interesting. And if we want to, Amanda can flash up some of the sectors right here, because when you and I on the opening started recording the Risk Reversal podcast, it was a sea of green, right? And what was down were the defensive stuff, the staples and stuff, right? And so look at what's going on right here. I mean, it's just not pretty. We're going to hit some of these sectors in a second here. But when you think about just kind of investors' unwillingness to take a shot on some stuff that's been beaten up, because if we talk about a NASDAQ down 13%, we've seen much of the leadership down a lot more than that. If you look at like an NVIDIA was down, 30% at its lows yesterday. Tesla was obviously down, 50% at its lows. The bounce is not particularly that impressive here. I see Apple, which I think had a downgrade today for some of the reasons that we were talking about. We'll hit that in a little bit, down 2.25%. Microsoft is down. Amazon is down. Google is basically unchanged. The banks, JPMorgan in particular, down. All the retailers, man, after yesterday, not particularly great here. I'm looking at defensive sectors like pharma. I'm looking at some of the industrials and the airlines a second day in a row. XHB down one. I mean, it just seems like a broad-based decline right here.
All right, so we're on a clock today, number one, so I don't want to take up too much time. But since you mentioned Apple, Amanda, pull up an Apple chart over the last whatever, and you see this sort of leg lower. And I'm sure you'll have people scratching their heads, oh my God, it's Apple. But what I've said for a while and what I believe to be true is the one company that wins to passive investing more than any other company in the history of mankind is Apple, vis-a-vis the amount of ETFs and funds they're in. And you've seen that obviously over the course of years where Apple is seemingly impervious. But one thing I've also said, Dan, and I know you know this, is when passive trading becomes active, what works for Apple is going to work against it. And I think to a certain extent, that's what we're starting to see over the last couple of days. The active trading is actively on the sell side. And as much as Apple wins to it on the way up, they lose to it on the way down when all these ETFs get sold, and then obviously the underlying security or stock, in this case Apple, falls victim. So you can't have it both ways, folks. You can't enjoy the upside and then obviously complain about the downside when the same exact thing is happening in reverse.
Yeah, no doubt. And we focused on this last night on Fast Money, and you and I were in agreement that it's not just the valuation that's rich, is the fundamentals actually suck. iPhones are not growing year over year, and the expectation, one of the reasons why investors bid it up after the announcement of Apple Intelligence is one of the reasons why, in November into, December, the stock had that ramp. You can see it right there. The fact that it actually has been outperforming on a relative basis to the whatever you want to call them, the Fateful Eight, it just doesn't make a lot of sense to me. So now that you have this technical degradation, this might be in the same camp as some of these other names that kind of pierced their 200-day moving average, went through some important support, on the charts. And again, to me, 30 times this year, fundamentals kind of suck. You're pushing out. They did. I think the Bank of America downgrade had to do with the fact that earlier in the week, they announced that they're, indefinitely pushing out the upgrade to Apple Intelligence. That was the story about the upgrade super cycle and then increased services revenue. So to me, not interesting. Guy, let's go to the call of the day really quickly.
By the way, something you said would happen months and months ago, but let's go to the call of the day.
Yeah. So this is David Costin. He is the Goldman's equity strategist over there, lowering his S&P 500 year-end price target from 6,500 to 6,200. I don't see a commensurate S&P EPS cut with that. So it seems like a bit of a vibe check. But what I took away from this guy is that he said The Mag 7 is now the Maleficent 7. So the Magnificent 7 to the Maleficent. You know what that sounds like? You probably know the meaning of
It's a Disney movie. Maleficent, if you recall the
Maleficent.
movie. So
Yeah,
I
you
mean,
know who
that
is in it?
basically.
Yeah, Emma Stone, which I think you're a big fan of.
I thought it was Angelina Jolie.
Could have been her too.
I really don't know.
You're probably a big fan of her. But when I took some heat, on the fast money, I want to say it was a few months ago. It was definitely in the fall when the Mag 7. Oh, here it was Angelina. That's what Amanda's saying. Obviously, she's all over that.
I don't even know. Listen, I just want to be crystal clear. I mean, as it is apparent to everybody over the last few years, we don't rehearse this. So when you're pulling, Maleficent out in the Disney movie, I mean, I just pulled that Angelina Jolie out of my ass. I mean, that was pretty impressive.
You did pull it out. And Amanda's saying Emma Stone was in Cruella. Cruella? I don't even know what the hell that is.
Yeah, Emma Stone was Cruella. That's 101 Dalmatians. She played Cruella DeVille. By the way, she was extraordinary in that movie. She should have won something. Back to you.
Saw that movie?
Yeah.
She was great in La La Land. I think you and I.
You know why it was because I like when human beings actually act as opposed to all this like cartoon shit that seemingly become de rigueur. Anyway, back to you again.
CGI. So David Costin saying the Magnificent 7 is now the Maleficent 7. And that was the whole point of my Fateful 8, is that the market's fate was in the hands of these 8 stocks. And to be frank, there was a lot of stuff under the hood that was degrading in the markets, but it wasn't until these names joined the party that we started to see the sort of decline. So I hope that makes some sense. But again, on the strategist front, start cutting your numbers, man. If you're going to cut by, your target, like it's got to be based on something. I hope he did. I didn't read the full note. I saw a write-up of it, but thoughts there, Guy?
Yeah, well, my thoughts are, as I said earlier today, but I'll say it here on Market Call. I mean, there are as much as people want things to be linear, there's nothing linear about the market. So, you're going to start to have these people cut. And by the way, we might wind up at 6,500 by the end of the year. I really have no idea. It's just question is, how do we get there? And, obviously we're enduring some of the pain right now. And I think most people never anticipated these types of downdrafts. As a matter of fact, if you watch CNBC on any given day, 90% of the people are pretty much convinced that the market is just basically lower left, upper right. Valuations make sense. This new golden age, you've heard it all before. One of the things that we've tried to point out is below the surface, there's some damage being done, and that volatility was going to become a story. Now, it obviously had no impact on the market for the majority of the fall, and for whatever reason, the market is taking notice now. It always seemingly comes out of the blue, and it's seemingly for reasons that you never envisioned, and whatever the reasons are, they're in front of us now. But now the market is obviously dealing with the other side of perceived certainty. And, it's acting in kind. So what do I think? Yeah, I do think they're going to be more and more of these strategists are going to start to change their numbers. But as Carter Worth says all the time, none of it is particularly helpful for those trying to play for day to day, or quite frankly, for those that are trying to figure out how to invest.
Yeah. So this brings us to the chart of the day. And if you just think about what the swing has been in consumer confidence, Guy, since the election, the idea that you're going to have this pro-growth, agenda, you're going to have deregulation, you're going to have tax cuts, all this sort of stuff. This is from Charlie Bolello. He's a good follow on the Twitter. I'm not on it, but Amanda, kind of shows us some of the stuff that she likes. This is with the S&P 500 in the midst of its biggest correction since last August. Sentiment among individual investors has turned decidedly negative. The percentage of bulls in last week's AAII poll, 19%, was lower than 98% of historical readings, while the percentage of bears in the prior week's poll, 61%, was the 7th highest reading in the survey history. Is this backward looking? Is it predictive of anything?
Okay. So if Elizabeth Young Thomas was on, and I love this conversation, and you may have a different view, but this is the way I look at it. Everybody can be bearish, as clearly this indicates, but it doesn't mean people are acting upon that bearishness, which is something that Elizabeth said. Mm-hmm. It's when you start to act upon it, then we can say this could be a counter indicator. But everybody could be sitting around saying, yeah, I'm really bearish, but until people start acting in kind, I don't think you can put in a tradable bottom. And people say, well, what are you talking about? Look at the sell-off we've had. I mean, this is a garden variety sell-off historically, in terms of what we've seen over the last couple of weeks. I don't think you've seen the capitulation when you see the capitulation in a form of a huge volume day where we reverse off the lows or something like that, you can sort of be storing this bull bear indicator in the back of your mind. But until people act on that bull bear indicator, the market can continue to go lower.
Yeah, no doubt. Good stuff there by Charlie Bolello, as usual. Let's go back to the sectors. Amanda put together a little screener there. And, some of the stuff sticking out to you and me, the fact that the XLY is up today, we know that, Amazon and Tesla make up a good chunk of that. So not particularly interesting to me. Amazon's down a little bit on the day. Tesla was up like 8.5%, maybe a little bit more. Now it's up 5%. When I think about some of these more cyclical sectors, we know that we've had weakness in retailers. We detailed the XRT yesterday. But what sticks out to you here, Guy? Because industrials, we get it. If you have big tariffs on metals in general, steel and aluminum, that's a big input cost for a lot of those. Anything and then we're going to hit the transports to me. And I know that your tube, a couple of the U's, it could have been the UPS. No, it's the Uber, right? In your tube, isn't that what the U is?
Yes, that's correct.
We'll hit that in a second. But any of these sectors stick out to you?
Yeah, financials, and we've talked about them, but throw up an XLF chart, although we've said 100 times it's not the best constructed ETF, or if you want to throw up a KRE, I mean, there's clearly something going on in the financials that I don't think a lot of people would have anticipated in the fall of last year, especially around the election. I think a lot of people would have thought off to the races here in financials, that term that I'm reticent to use, animal spirits and those types of things. And, you saw that obviously gap higher on the back of the election. Well, guess what? We're actually lower than we were on election day, which I don't think anybody had on their bingo card. And now, whether it's the KBW in the form of the BKX or the XLF or whatever you want to look at, I mean, technically, we're at some pretty important levels here. You see the XLF is flirting with the 200-day. As we just saw before, the BKX is through the 200-day. I mean, banks are at a critical level here. And as I've said, as I will continue to say, as I'm sure I will say tonight on Fast Money, as much as people want to say it's different this time, banks are extraordinarily cyclical. And if there is a slowdown, and by the way, this CPI number today suggested exactly that, then banks are not going to be immune to that, Dan. And I think that's what we're seeing.
All right, we got to pull up one bank. It's the bank. It's JPMorgan. Let's look at the 1 year. And what's fascinating to me, Guy, the stock was trading 220 on election day. It had that huge one-day gap. And then, this 3-month performance from 220 up to 280. Okay, here we are down 18% in what feels like, so, this is the whole escalator up, elevator down sort of situation. It's sitting right on its 200-day. Let's pull out to a 5-year, because this is one of the things that you could have looked at this and said on a short-term basis, 220 is the level. You know what I mean? Like, you want to get long there for a bounce. And it may be a good trading level, but look at where this stock has been and look at where it is right now. It hasn't been below that 200-day moving average since late 2023. We know that 2023 was a tough year generally for, regionals. But, again, JPMorgan was the beneficiary. Which one did they? First Republic, they got to gobble up, you know what I mean, for a steal. So to me, this doesn't look that interesting. But the fact that this thing's down 18% in a straight line, that's not just profit taking. That's like some worry about something else. I
think it's growth concerns. It's the fact that you talk about the strength of the economy, the strength of the consumer, but I think it's a bit of a mirage. I've said that for a while, and I think the banks, or at least people trading or investing in the banks, are starting to pick up on it. And we're at a pretty critical level here. And if Amanda, I don't know if this is a static chart or not, but if you go to sort of, I don't know, early last year when the stock was trading 203, move it back over to my right. If you keep going right there, this is around the time that Jamie Dimon, if you recall, said, I don't know what question he was answering, but he said his stock was expensive and they weren't going to buy back any stock. That was, again, we obviously then subsequently traded higher, but that was where we trading now. I mean, that was some $20-something ago. So there's still room to the downside. JPMorgan is still an expensive stock. And, you get to close below this 200-day. And, I think we're going to start to see that sort of 205 level that we flirted with again last year. That was a prior all-time high.
Yeah. Let's go to the transports for a second, because this is one, you and I have been remarking since, I want to say, late November, early December, about some of the sectors that had big rallies after the election. Again, this goes back to that kind of pro-growth agenda, tax cuts and deregulation and all that sort of stuff. How quickly they gave it up. Like, look at this one. Not only did it give up the move from November 5th, but it overshot it dramatically. Yeah, there was a bit of a bounce early this year, but look where it is right now. 3 of the top holdings here: Uber at 19%,
The used.
Union Pacific at 18, and UPS at 11. I think we could all agree that those are some very, very cyclical names. Then it's Norfolk, CSX, FedEx. So when you look at the IYT, you say to yourself, wait, what is this saying about the U.S. economy?
Uber being in there doesn't make a lot of sense to me, but it's in there. So let's play the game. And what it says is, if transports, again, regardless of what you think about Dow theory, are some of the most economically sensitive names, and if you put up that chart again, I mean, what is this telling you? Maybe the economy is not as robust as people would have you believe. I mean, that's a shorter term chart. Put up a longer term chart just for context. I mean, this is clearly rolling over, Dan. And people can explain it away, and transports aren't as important as they were when the Dow theory, Charles Dow, and all that stuff. But the reality is they're still pretty important. And if you look at this chart, I mean, you've seen some pretty significant drawdowns on the transports over the last year or so. And you sort of get through that August low, then you tell me. It looks like we're going to look at levels that we last saw probably in the summer of 2023, which is still significantly lower than we are now.
Yeah, and that takes us to retail, XRT, and you and I have been documenting over the last few weeks as we had earnings. There wasn't too much that you could have said was positive out of those earnings that we saw. And, that one is pretty fascinating to both of us, just because, the COVID bump that it got, we saw the hangover, if you will, and a lot of the stocks there never really got going. Now there's some, and I think you want to show us a couple that just had these epic moves. The first one was Abercrombie. And again, you and I thought these were silly and they way overshot to the upside, but look at how they're doing to the downside.
Abercrombie and Fitch was a turnaround story that was making sense until it's no longer made sense, and then the market sort of caught wind of it. And again, I'm not casting blame or casting aspersions against Abercrombie and Fitch. I mean, they don't have control over what the market does with their stock, but at a certain point, this stopped making sense. And now you have a moving average. It's rolling over. And one has to ask, is it going to revisit the entire move, or basically do a round trip of the entire move that started basically around this time in 2023? That's number one. The other one is Restoration Hardware, which is another great story. But you think about what RH, you think about the customer that they serve. I mean, this is very economically sensitive as well. And go longer term chart. This was north of $700 at one point, and now look where it's trading. I mean, this is a huge support level. Amanda can draw that horizontal line across, but she doesn't have to, because you can see. I mean, this is huge support going back to, I don't know, the spring of 2022. So one has to ask himself, what's going on here as well? What is really happening with the real economy?
Yeah, Stop Making Sense. A fantastic live Talking Heads album, guy. Was probably right in your
Talking Heads.
Really?
I have 900 songs on my Spotify. Now I'm allowed to say Spotify. For a while, you didn't let me say it because we were on the radio. And what did they use?
Sirius, and it was Pandora. I didn't say
Pandora.
You weren't allowed.
No,
but
you said you're not allowed. You basically, which is fine. I mean, it's you have to cater to the people you're working for. But on my 900 song Spotify playlist, there is not one Talking Head song.
Amanda just put in our chat, called out, all caps there, guy.
What does that mean? Is that good or bad?
Yeah, you called my shit out is basically what you said.
I don't know. Like all these things, I don't understand.
Right, so really quickly, Amanda, pull up a 1 year of Walmart. And, this to me, and this is, call me Captain Obvious, okay? This is, to me, one of the most important charts in the entire market. Both of you and I know you've been bullish on it this whole way up, and you look at what's gone on with those gaps, and you see lower left, upper right, that sort of thing. It just seemed to be as euphoric as I've ever seen about a mega cap retailer. Now, we just showed you A&F. We just showed you, Restoration Hardware. Those are little market caps that get pushed around. This is a global company that has, their finger on the pulse of not just this economy. They're big in China, right? And I don't know if you saw this, that some Chinese regulators pulled in the Walmart, the folks that run Walmart China, and trying to pressure them to bring down prices. Isn't this the low cost? I don't know what the hell their tagline is, but this
everyday
is
low cost, or I don't know.
everyday low prices. So this is down 18%. Guy, let's pull it out to a 5-year. The last time this stock had a drawdown like this over 15%, you got to go all the way back to early 2022. You remember they were working on those inventory issues with COVID. So this to me is easily going to that 200-day, but there is no support. You got to go all the way down to like the high 60s of that last gap.
Well, for you Eddie Murphy fans and Coming to America, not Coming to America, The Golden Child, ain't no floor here. If you remember that scene,
No
Monty.
one remembers that.
Movie.
I mean,
and there are people that remember
on a
that.
scale to 1 to Coming to America, The Golden Child is like a 2.
I'm pausing because I no, that's not true. It's a great movie. I mean, if Eddie Murphy could read the phone book.
How many Rotten Tomatoes does that thing have? I mean, it's just.
I don't know. Amanda can look it up. In the meantime, it was a great movie. In the meantime, let's talk about now. Listen, you're right. We were bullish in Walmart for a long time, and actually into earnings. I think on Market Call we said you have to move your feet here. Valuation is out of control, and they're going to be hard pressed to say something that's going to have the stock continue. Now, if I'm being honest, which I will be, I didn't think we'd get down to levels we're seeing now so quickly. But if I'm also being honest, you still have that gap in the chart. If you go back to last summer, where we gapped higher, if you recall, and it might have been on the first iteration of them talking about AI and how they're having an impact on margins. Now, the moving average comes in around 80-ish, probably going to test that. And then we'll see, if there's a prolonged sell-off in the market, Walmart's not going to be, again, immune from that. So you could absolutely see a gap fill. But I'll say this as well. I mean, Walmart still wins to this environment more so than any of these other retailers.
Yeah, let's quickly hit Adobe reports today after the close, 8.5% implied move. This stock has been a huge mover, Guy. The day after earnings, I think on average about 12.5% or so. This
scary movie the day after, by the way.
Yeah, that was the early 80s. Remember what it was? It was the height of the nuclear, war scare. Russia was the.
I think it was on like on a Sunday night.
Just think about what's happened in 40 years, Guy. Russia was the evil empire.
Soviet Union. It was the Soviet Union. Yeah.
And they have not been our friend really since since the World War II.
And they weren't our friends then. If you go back, and now I'm doing a history lesson. I mean, George Patton, if you remember, Patton went to the president and said, let me kick the Russians' ass, otherwise they're going to be a problem. And they sort of backed them into a corner and said, no, George, relax on this one. Turned out he was right. But anyway, back to you.
Yeah, now there are allies for some way, shape, or form. I don't know how that happened. Adobe, Guy, 11% expected EPS growth this year. About the same as it, let me tell you what it is on the revenue basis, expected to be about 10% and about the same for 2026, trading 21.5 times this year, 19 times next. This is nearly a 90% gross margin company. They've been trying to tell a generative AI story, except that one of the problems here is a lot of their products and services are being disrupted, right? By generative AI, if you think in the creative space and that sort of thing. You look at this chart, you see those two gaps. Right. Last spring, it was gap up, huge gap, continuation. Then we saw a gap lower in the next quarter. And then we saw a gap lower in the next quarter. You see where that 200-day moving average is. This is purely technicals. You could make an argument that if these numbers are intact, if they don't guide lower for this year, then this is probably a pretty reasonable sort of valuation, especially if they can start telling a story. But as far as I'm concerned, I don't know what that story is right now, guys.
All right, let's go to the longer term chart. And you go from the September 2022 low, Amanda. Oh, my God. This is like you guys did this for me. I mean, I didn't even know this was here. Yeah. And you see this pennant formation. And, the question is, which way do we break out? I mean, I'll be honest with you here. I mean, given the valuation, which, might be a little stretched, but given their dominance, I mean, this is one I'm actually inclined to think you could take a shot on the long side. But in this environment, as you've seen, I mean, people are selling first, asking questions later. So I think you got to wait, in my opinion, wait for some sort of resolution of this pennant formation and then trade accordingly.
All right. before we get out of here, Guy, I think this is important. This is our main man, John Butters. He's the senior earnings analyst over there at FactSet. His senior earnings analyst at FactSet. You see what I did there? All right, you ready for this?
Let's do it again. By the way, you know what today is, Dan?
Wednesday.
Which means today is John Butters.
Right. He's the senior earnings analyst at FactSet. He writes the Earnings Insight Report. It drops every Friday. We get a preview of it. If you want it in your inbox on Friday morning, you can go right here. Jacob's going to pull that up for me in a second. And, this is something that you and I have been reading for a long time. We think a lot of the data that we get from this on a weekly basis is fairly or very useful. FactSet.com/insight/subscribe. So have it in your inbox. But this one today, we've been tracking, or John's been tracking some of the mentions on earnings call. We are basically through S&P 500 earnings for the Q4 period. We've gotten lots of guidance. The commentary has basically been about trepidation about the markets, about the economy, that sort of thing. But there's still a lot of enthusiasm about generative AI. Mm-hmm. One of the big stories in the market for us is like, did we reach a fever pitch as far as mentions and the like? So John's tracking this right here. The term AI has been cited on the Q4 2024 earnings calls of 239 S&P 500 companies to date. This is the highest number going back at least 10 years. The previous record was 212 in both Q1 2024 and Q2 2024. Talk to me about those numbers, those increases.
Well, it's I like these things. I think last week we did tariffs. We've done a number of different things. I think recession was one we did many different times over the last couple of years. And what I've learned from John's work is typically when everybody, or not everybody, when a lion's share of companies are talking about one thing, it typically is signifying a bit of a top. And, quite frankly, if you were to overlay some of these stocks with some of these sightings, you would say, you know what, that actually makes a lot of sense. So I understand why companies are saying it. They're almost forced to say it if they have any adjacency whatsoever to AI. But one has to ask, and I think that's what we're trying to address here, does that signify a bit of a short-term top? And my answer is yes.
Yeah. So the next two bullets are really interesting to me. The last one in particular, the information technology sector has the highest number of S&P 500 companies citing AI on earnings calls at 61. Okay, not a big surprise. The next one's interesting to me. 9 of 11 sectors recorded a quarter-over-quarter increase in AI citations, led by the healthcare sector. Now, there's a whole host of reasons why you could say that. Not too different than like 26, 27 years ago. A lot of companies that want to get on this whole internet sort of craze, they would put .com after their name or talk about, how they're going to harness the technology of the internet and this and that or whatever. One of the things that I think, and I've been saying this for a bit of I don't know if it's going to be true or not. I think the next leg of the generative AI trade is not going to be the picks and shovels. It's going to be industries like healthcare that are made the investments, or they're using the technology to get better productivity or better research and development, all these sorts of things. And then that starts getting appreciated in the earnings growth of these companies. And therefore, maybe they get revalued a little bit higher, especially as we have this sell-off and you're taking turns off a lot of these multiples. Thoughts there, guys?
That makes sense. I mean, it's not going to just be healthcare. I think it's going to be a swath of industries. I mean, I think you'll see it in manufacturing, industrials, without question. But I think we're probably a ways away in terms of that. But listen, there's no denying the technology. I mean, I don't think we're trying to do that. What we're trying to do is sort of explain how some of the valuations and some of the moves on the back of it have gotten a little bit out of control. And we'll try to be ahead of the curve in terms of who we think is going to benefit. But right now, I think it's more people not necessarily not benefiting, but we're sort of on the other side of some of the euphoria here, Dan.
Yeah, no doubt. And, one of the things I think is really important to kind of mention here is that, okay, so if the hyperscalers, Amazon, Google, and Microsoft have overbuilt, right? Let's say they've spent too much on building out these data centers, the servers and the processors that go in them. And then you see the costs come down. They start competing on price. There's going to be other upstarts. Well, that's good for all these other industries that are basically going to like rent this compute out of the data centers and use the models there. So that's probably, to me, the most important takeaway of what we see next as we get into, the back half of this year into 2026. All right, Guy,
that was get out of here, man. Yeah. You better haul ass because you got to be somewhere.
I got to go to the airport, and I'm going to be back tomorrow, though. It's going to be a quick turnaround, guys. So if you want the Earnings Insight blog from John Butters in your email box on Friday morning, you know where to go. FactSet.com/insight/subscribe. It will be one of the best emails you get all morning, Guy, on Friday.
He's the senior Earnings Insight
analyst All right,
I
stop.
crack myself up. All right, listen, this has been fun. I'm actually going to speak to Peter Bookvar. That's going to drop, I think, tomorrow, if I'm
Tomorrow
not
morning,
mistaken.
the Risk Reversal
The Risk
podcast in
Reversal
your favorite
podcast.
podcast store.
So be on the lookout for that. Peter's always great. And we'll be back tomorrow with Market Call, 11 a.m. And then we're going to sit down with Vincent Daniel tomorrow for the Risk Reversal podcast that drops on Friday. A lot going on.
Yeah. All right, peeps. Thanks so much. See you tomorrow.